If I woke up tomorrow and my entire investment portfolio had disappeared, if I had to begin again with absolutely nothing invested, no stocks, no funds, no savings growing in the market, I would approach things very differently from how I did when I first started. Not because investing is complicated, but because when you're new, you don't yet understand what actually matters. Most beginners spend their time worrying about the wrong things. They obsess over which stock will explode next, which company might double, or which trend everyone is talking about online. They spend hours scrolling through investment videos, forums, and social media posts, looking for the perfect opportunity. But the truth is that successful investing rarely comes from chasing the next big thing. It comes from building a strong foundation, developing simple habits, and staying consistent for a long time. When I first entered the world of investing, I made the same mistakes that many beginners make. I rushed in before understanding the basics. I paid too much attention to hype. I worried constantly about whether the market would go up or down tomorrow. Looking back, I realized that if I had simply followed a few core principles from the beginning, the entire journey would have been smoother, calmer, and far more effective. So imagine starting today with a completely blank slate, no previous investments, no portfolio history, just a fresh start, and the knowledge that you want to build long-term wealth. What would be the smartest way to begin? The first thing I would focus on has nothing to do with buying stocks or choosing investments. It would be getting my financial life organized. This step might sound boring compared to the excitement of investing, but it is actually one of the most important parts of the entire process. Many people try to invest before their finances are stable. They open investment apps, buy a few assets, and hope the market will help them get ahead quickly. But when life throws unexpected challenges their way, those investments suddenly become a source of stress instead of opportunity. Unexpected expenses happen to everyone. A medical bill appears, your car suddenly needs repairs, something in your home breaks, or income temporarily drops. If you don't have money set aside for situations like these, you may be forced to sell your investments at exactly the wrong moment. And when markets happen to be down during that moment, the loss becomes real. This is why a solid financial foundation is so important before investing seriously. The first priority would be removing expensive debt. Debt that carries high interest rates can quietly destroy financial progress. Credit cards and similar forms of borrowing often charge extremely high interest, sometimes far higher than the average return of the stock market. Imagine trying to grow money through investing while another part of your finances is shrinking because of high interest charges. It's like trying to fill a bucket that has a hole in the bottom. Paying off that kind of debt first allows your future investments to actually work for you instead of fighting against your financial situation. The next step would be building a financial safety net. Life becomes much less stressful when you know that you have several months of essential expenses saved somewhere safe and accessible. This emergency fund acts like a buffer between your daily life and your long-term investments. Instead of worrying about every unexpected expense, you know that you have a cushion available if something goes wrong. And that peace of mind makes it far easier to stay invested when markets fluctuate. The third part of building this foundation would be understanding exactly how money flows through your life each month. That means knowing how much income comes in, how much is spent, and how much can realistically be set aside for investing. Without this clarity, investing becomes guesswork. With clarity, investing becomes a deliberate and controlled process. Once those basics are in place, the next step would be deciding what I am actually investing for. This is something surprisingly few people think deeply about. Many individuals start investing simply because they hear it's the responsible thing to do. They download an investment app, pick a few assets, and hope their money will grow. But investing without a purpose often leads to poor decisions later. Goals provide direction. Some people are investing because they want the option to retire early. Others want long-term financial independence so they have more freedom in life. Some want to build wealth that can support their families or future generations. Whatever the goal may be, identifying it clearly changes the entire strategy. Another factor that matters just as much is time. Money that will be needed in the near future should usually be kept somewhere stable because markets can move unpredictably in the short term. But money that can remain invested for many years benefits greatly from being in the market. The longer money stays invested, the more time it has to grow and recover from temporary downturns. Once goals and time horizons are clear, the next step becomes choosing where those investments will live. At first glance, the number of investment platforms and account types can seem overwhelming. There are brokerage accounts, retirement accounts, tax-advantaged accounts, employer plans, and many other options depending on where someone lives. But despite all those choices, the core idea remains simple. An investment account is simply a place where you can deposit money and use it to purchase investments. Once that account exists, you have entered the world of investing. Many employers also provide retirement plans that include contributions from the company itself. When opportunities like that exist, they can provide a powerful advantage because your investments grow not only from your own contributions, but also from the additional support provided by the employer. Beyond that, some countries offer accounts designed specifically to reduce taxes on investment gains. Using those types of accounts whenever possible can make a significant difference over many years, because more of your returns remain invested instead of being lost to taxes. After opening the account, the next step would be to begin investing as soon as possible, even if the amount is small. One of the biggest misconceptions about investing is that you need a large amount of money to begin. In reality, consistency matters far more than size. Small amounts invested regularly can grow into something surprisingly large over time. This happens because of compounding. Compounding occurs when investment gains begin generating their own gains. At first, the progress may appear slow. In the early years, growth might feel almost invisible. But as time passes, those returns start building on top of one another. The effect is similar to a snowball rolling down a hill. At the beginning, the snowball is small and moves slowly, but as it continues rolling, it gathers more snow and becomes larger and faster. Investing works in much the same way. The key is allowing time to do the heavy lifting. Another important principle I would follow from the beginning is diversification. Many new investors concentrate too heavily on a single idea. They might buy only technology companies, or only cryptocurrency, or a handful of individual stocks they believe will outperform everything else. The problem with this approach is that it places too much risk in too few places. If that specific area struggles, the entire portfolio suffers. Diversification spreads investments across many companies, industries, and regions of the economy. This way, the success of the portfolio does not depend on a single outcome. Some areas will perform better during certain periods, while others may lag behind. But over long periods of time, this balance helps reduce risk while still allowing steady growth. One of the simplest ways many investors achieve diversification is through broad market funds that track large segments of the economy. Instead of trying to predict which individual company will succeed, these funds invest across hundreds or even thousands of businesses at once. This approach keeps investing simple while still capturing the overall growth of the market. Once the investments are chosen, the next thing I would do is remove as much emotion as possible from the process. Human emotions can be one of the biggest obstacles to successful investing. When markets are rising, people feel excitement and sometimes invest more than they should. When markets are falling, fear appears and people often sell at the worst moment. One of the most effective ways to avoid these emotional decisions is automation. By setting up automatic transfers from a bank account into an investment account each month, investing becomes a routine rather than a decision. Money flows into investments regularly without requiring constant attention. This creates discipline automatically. Instead of waiting for the perfect moment to invest, you invest consistently regardless of short-term market movements. Over time, this strategy smooths out the ups and downs of market timing. It also removes the stress of wondering whether today is the right day to invest. Finally, there's one lesson that every investor eventually learns. Markets will drop. At some point, every investor experiences a moment where the value of their portfolio declines. Sometimes those declines are small and short-lived. Other times they feel dramatic and frightening. But history shows that downturns are a normal part of the market cycle. Over many decades, markets have faced recessions, economic crises, political instability, and global emergencies. Yet over long periods of time, they have continued moving forward. The investors who benefit the most are usually the ones who stay patient during those difficult periods. Instead of reacting emotionally, they continue following the strategy they established earlier. They keep investing consistently. They allow time and growth to work together, and eventually the market recovers, often reaching levels higher than before. This is why everything discussed earlier becomes so important. A strong financial foundation prevents panic during emergencies. Clear goals provide direction. Diversification reduces risk. Automation keeps contributions consistent. Together, these elements create a system that supports long-term investing even when emotions try to interfere. If I were starting from zero today, this is exactly how I would rebuild my investing journey. I would begin by strengthening my financial base, making sure debt is under control and emergency savings are available. I would define my goals clearly so that every investment decision supports a long-term purpose. I would open the appropriate investment accounts and take advantage of any benefits available. I would start contributing regularly, even with small amounts, allowing consistency and time to do the heavy lifting. I would diversify my investments rather than betting everything on a single idea. I would automate the process so that investing happens quietly in the background of my life.
And most importantly, I would remain patient during the inevitable ups and downs that occur along the way. Because investing is not about being perfect. It is about being consistent. It is about understanding that wealth is usually built slowly, step by step, year after year. And the sooner that journey begins, the more powerful time becomes as your greatest financial ally.